Alright guys, so let's talk about China today and we have to focus on Beijing's move against the US. They aren't going to listen to US orders and contain their own economy for Trump. Now by now we know the US has been trying their best to contain China. Now we can point to the tariffs, we can point to the chip sanctions, but the US has been doing quite a bit to hinder China's financial markets as well.
Going forward, the bank must set firm graduation timelines for countries that have long since met the graduation criteria. Treating China, the second largest country in the world, as a developing country is absurd.
Now, a month ago, Besson went to the Asian Development Bank and basically told them not to lend China money anymore. So if you are China, you will be pissed off. In this economic war, every country will be using whatever advantages they have. Now, the US has their financial system and the dollar. However, in a twist of fate, that is being dismantled thanks to the trade war. Now, another weapon Trump is using is the US consumer market. And the most direct way is to embargo Chinese goods from entering. Now, the tariffs have dropped back down to 30%, but still a very punitive amount. During the Global Finance Forum, Besson also told China to play ball, to manufacture less, to consume more, and to allow the US to produce more.
China's economic system, with growth driven by manufacturing exports, will continue to create even more serious imbalances with its trading partners if the status quo is allowed to continue. Everyone knows it needs to change, and we want to help it change because we need rebalancing too. China can start by moving its economy away from export overcapacity and towards supporting its own consumers and domestic demand. Such a shift would help with global rebalancing that the world desperately needs.
Now that sounds innocent enough, and yes, I do agree that China needs to boost their own domestic consumption as well. The Chinese government, they're taking steps to stimulate their economy, and it's going to take some time. But they're not going to listen to the US. Beijing is now embarking on a new Made in China plan. They are rejecting Scott Betten's orders to rebalance and to produce less. What do you think is keeping China immune to US sanctions? Why do you think countries like Japan aren't joining the US trade coalition to contain China? There must be a reason. It's because of their industrial production. Now, since 1990, China's manufacturing has been flying to the moon, hitting nearly 30% 2 years back. In contrast, America's share of manufacturing has been declining from nearly 30% down to just 17.2%. The world is more dependent on China for their trade than the US. And that's why Besson just can't convince countries to join his weird coalition, his Fortress America plan to contain China. Beijing is currently discussing their next 5-year plan, which will go live in March 2026. So discussions will take some time, but we can already guess which industries will be the main focus. Without a doubt, it will be semiconductors, AI, and robotics. Those will be the main drivers of manufacturing to help China really secure their market share. Now, Besson thinks of things in very binary terms. China must lower production and increase consumption. But I can tell you right now, Beijing's plan. They will grow domestic consumption and boost production at the same time. Manufacturing today is the backbone of China's economy. It accounts for 25% of total GDP. China can't afford for this to go down, especially if they want to win the chip war. The manufacturing component and the ecosystem also makes them sanction-proof against the US. And this allows China to be useful to the world. So if you're France or Germany, why would you punish China if your factory is in Shenzhen? If you are benefiting from their industrial ecosystem, sanctioning China means sanctioning yourself. And we have to be clear, China's exports are not going to stop. They might consume more of their own production tomorrow. But Chinese companies won't stop growing their footprint. Remember China's property collapse? Well, their machinery giants are shifting their sales overseas. Chinese property developers might be too afraid to build homes, but other countries aren't. Chinese trucks, for example, are being manufactured in an ultra-competitive and cost-efficient environment. CATL, for example, is part of the Chinese domestic supply chain. So electric machinery and trucks coming out of China will be the most cost-competitive in the world. And if you remove US tariffs on Chinese machineries, they're probably 50% cheaper or even more. Even after the property crash in 2022 to 2024, Chinese machinery giants aren't collapsing. While domestic sales are falling, their overseas revenue is going through the roof. This is a key reason why the central government won't give up on manufacturing. If domestic Chinese consumers can't buy for whatever reason, China still wants to sell to the world. Trump is actually doing the same thing. He does it by threatening tariffs to force countries to buy more US products. Beijing's approach is very different. It's just to be more competitive. But let's go on the offense now because China has such a big consumer base, customer base around the world for exports, they can start to dictate the terms of trade. Take China's trade with BRICS for example. In Q1 this year, it reached 1.5 trillion RMB or around $210 billion, and this amount is up by 11.3% year on year, double digit growth. It's a clear sign that China can eventually survive without the US markets. The BRICS bloc is growing, especially Southeast Asia. So if Washington wants to jack the tariffs higher, Beijing won't be begging for mercy. Now, if you're China, do you want to trade with the world using dollars, or would you rather use your own local currency to get things done? Now, the answer should be mighty obvious. By using dollars, you expose yourselves to many problems. You could get sanctioned tomorrow. Being too dependent on dollars means keeping more treasury bonds as reserves as well. And China doesn't want that. So they are ordering their major banks to dump dollars and use RMB in cross-border trade. The PBOC increased the floor ratio for yuan-denominated transactions from 25% to 40%. So 4 out of every 10 transactions should be settled using the local currency. When the Chinese central bank tells you to do something, it's not really a recommendation, it's more of a directive, and we can be sure the commercial banks will follow suit. By de-dollarizing their trade, China is playing both defense and offense at the same time. Now, when you buy and sell using the RMB, you drive demand for the Chinese currency. This makes it more attractive to hold. It's just like the dollar system. When countries hold more of your currency or they tend to use it more, they more or less recycle it back to your financial markets. So if you're holding Chinese stocks, de-dollarization is very good news for you. Now, Goldman expects a stronger Chinese yuan to boost Chinese stocks, which is what will happen the more Beijing de-dollarizes their trade. Every 1% appreciation of the RMB versus the US dollar can boost Chinese equities by 3%. Obviously, China doesn't want too strong a currency for their exports, but as domestic demand grows, this will give them more flexibility for the RMB to strengthen. Thanks to this trade war, a new trend is forming. Investors are really dumping dollars. As the RMB rises, it will attract more capital into Chinese markets. And remember what this also does. It puts additional downward pressure on US assets. Money that flows into Chinese stocks will be money denied into US assets. China's gain will be Trump's loss, and China isn't playing around here. The potential left for de-dollarization is tremendous, which means even less global reserves piling into US markets, and this is a very major pillar that's keeping asset prices high. According to Pan of the PBOC, China's total imports and exports of goods amounted to 43.8 trillion yuan. That's a mind-boggling $6.1 trillion worth last year. But so far, the proportion of cross-border yuan payments in goods is only at 30%. There's over $4.2 trillion worth of trade to shift to yuan payments. And now that Beijing is telling their banks to clear trade in the RMB, we can expect this number to rise. We could end 2025 with 40% of trade in the Chinese currency. Now, good news for China stocks, bad news for US equities and bonds. But we must also touch a bit on the Tesla situation, or more specifically, what BYD is doing to Elon's company all over the world. Now, we said before how the Chinese market is hyper competitive, and BYD they just dropped a shocking announcement that might be the start of a price war ahead. BYD is offering discounts on many of their models, and we are talking about 10 to 30% off the existing price tag. BYD cars are already very affordable, and cutting prices now is most definitely going to spark a price war. Now, if you're like other Chinese companies, for example, like NIO, you probably rise to the occasion. You're already structured to fight a price war like any other Chinese company out there. But the same cannot be said for Tesla. Even though cars are made in China, prices are still much higher. And because of that, Tesla just can't compete in the Chinese market. In April, China's overall sales of new energy vehicles rose by 42% to 1.14 million units. That is a crazy amount in just 1 month. But look at Tesla's deliveries in late 2024 and 2025 in yellow. This is the seventh consecutive month of crashing sales. They barely sold 60,000 units in April. Remember that Tesla is manufacturing in the same ecosystem as well, but they need bigger margins, and some components, around 10%, are imported from the US. So Tesla hasn't fully localized their supply chains in China yet. And going forward, I suspect they have no choice but to do so if they want to survive in the Chinese market. Tesla has a very big problem, and it's not really Elon Musk today. The damage has been done for sure, but the big risk on Tesla and any other US brand or company is Donald Trump. Here's the thing that the president still doesn't understand. Countries don't need to impose tariffs on your exports like cars to be effective. People and consumers simply choose not to buy. And this situation is happening in Europe. In a really stunning move, BYD's sales ranking in the bloc has overtaken Tesla. Now, this is very significant because BYD is actually facing higher EU tariffs versus Tesla cars. BYD vehicles face a tariff of 27%, while Tesla EVs made in China face a tariff rate of less than 18%. Now, both vehicles are made in the country, but the treatment is very different. But yet, Tesla still lost to Chinese vehicles. And now, with the price cut from BYD, we can expect Tesla to lose even more market share. Now, did all of Elon's political stunts and mocking Europe really play a factor? I'm sure it did, but at the end of the day, consumers they just want a good deal. A Tesla EV might look good and sound cool, but it's just too expensive for what it does. Chinese EVs are just too competitive as well, even with the tariffs slapped on them. But let's head back to the US financial markets and how China's strategy will make things worse. Now, thanks to the incoming tax bill, the big beautiful bill, we are headed back towards a record government deficit. And it really hasn't been a new thing. Ever since Bretton Woods, the entire system relies on the US to run a deficit. Over the past 5 years, the government deficit has averaged at least 9% of GDP. That's an incredible amount of money to be borrowed, except in the past, trust in the dollar and US bonds were still high. And if we are running at 9% before a recession, what will happen when a crash happens? We are looking at double digits easily, maybe even 15% or more, since we are starting at such a high base. Which is why China's plan to de-dollarize the world is a really frightening one. It threatens to lock the US in a world of high interest rates, which slows down the economy. Now, never before in living memory, at least for most of us, have gone through an entire bear market cycle in US bonds, and this time is courtesy of the trade war and endless government spending. The last great bond bear market was in 1946 to 1981. Yields went from 2% to over 15%. So bond investors got absolutely nuked for 35 years. Now we are 5 years into one now, and if history is any guide, yields could definitely go higher. Unless we get a recession where everything collapses, the 10-year could hit 5% or even higher in the next 12 months. China's move to cancel the dollar in global trade will just hasten the process. You can't put the genie back into the bottle this time. This is quite irreversible. But let me know what you think. Will China ever give up their production for the US? And what other levers can China pull to push out the dollar? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.